Firstly, the transition from you being in the business to on the business to exiting within the space of effectively 24 months is bloody incredible, just to say that. When you made that decision to build the team, what was the first thing you did?
Let's just be 50-50 partners. And he's like, are you crazy? I'm like, no. I've painted the picture of what I want to do, which is basically create a $1 billion online education roll-up. Money doesn't matter to me anymore. The irony is, since making that mindset shift, I've probably made 10x my net worth.
A very warm welcome to the Creative Dealmaker podcast. I'm Carl Allen, I'm your host, and I'm going to be interviewing expert guests sharing investor strategies that will completely and utterly disrupt the market when it comes to buying and selling businesses all over the world.
Well, hi everybody, it's Carl Allen. Welcome to the Dealmaker podcast. Got a very special guest on the show today. Very, very good friend of mine, one of my massive peers in the M&A industry. It's my very good friend, Nick Bradley. How you doing, buddy?
Hey, Carl, it is a pleasure to be here. And about time you bloody started a podcast.
I know, man. I was on your podcast. It was in COVID, wasn't it? I think.
Do you know what? I've been running my show for like 5 years now, and you were one of the first interviews actually, because I started off by not doing interviews, right? It's just me talking to the microphone, but then I had to get you on to talk about all things acquisitions back then.
I know. I remember it vividly, right? It was in COVID. I was working from my house. I was on the third level of my house, and it was so freaking hot. Remember in COVID, it was like really, really hot in England. I was in England at the time, not in Florida where I am now. And I remember having to open the vent, and literally I was sweating profusely.
I can remember that now. It was a hot day. That's right. Because I live in an old place with thick walls, so we don't quite have that. But yeah, that was COVID. Feels like a lifetime ago, mate. But yeah, it was a few years back now.
I know, cool. So obviously we're good buddies. I know everything about you, but for my listeners on the podcast, and this obviously goes on YouTube as well. So for all of my peeps, like, tell us who's Nick Bradley. I know, like, what are you doing now? But then, where did it all kind of start for you?
I'll give you the brief version, the brief version of what's a long story. So I started a business back in the day when I was in my sort of late teens, about 19 years of age. It was a personal training business.
Nice.
And this is back like in the early 90s when having a personal trainer was an exclusive thing, right? So you had high net worth individuals, doctors, lawyers, stockbrokers, and all that sort of thing. So I managed to build up this clientele of very influential people. But because I was stuck in a place called Adelaide, South Australia, I realized back then there wasn't much hope for me to be doing much there. So I sold that business 3 years later.
Nice.
And I joke about this sometimes. I sold it for 3,000 Australian dollars, Carl.
Really? $3,000? Legend.
A Starbucks coffee is probably more expensive in certain parts of the world.
Australia.
But I joke about it because I say that was my first exit, right? Yeah, my first experience of selling a business for $3,000. I redeemed myself over the years.
I'm sure.
But anyway, but yeah, thank God. But what ended up happening is because I had those high net worth clients, I got introduced to Rupert Murdoch. And that allowed me to move from Adelaide to Sydney. And I worked for a subsidiary of News International, which was called Murdoch Magazines. And I started off in marketing, but then started to get involved in corporate finance and some of the more strategic nature of how they were kind of growing. And a lot of that was acquisition. So I started to get involved in joint ventures and acquisitions around the mid-90s. And from there, I moved to another media company that's based in the UK called EMAP. And they were the second biggest consumer publisher in the sort of early 2000s. And I went from Sydney all the way over to London to again work in the strategy department. So I was the marketing and strategy director for the second biggest division of that group, which was a whole heap of magazines like, car magazines and golf magazines. We acquired 25 separate brands while I was there over 8 years. We had around about 45 brands in total across all sorts of sports and interest levels. But what was interesting about that is the business got sold in 2008. It was one of the last big exits before the market crash.
Yeah.
And I was involved in the, I suppose, internal deal team. And I learned a lot about how you need to restructure companies and how you profit up before you exit.
Yeah.
And we ended up getting broken up and sold to a private equity firm. And then we got sold partly to a big corporate called Bauer Media out of Germany. And I ended up, amazing stuff. And anyway, from there, I got a taste, I think, for really this interesting world of private equity. And I went to Getty Images in New York. And again, I was involved in sort of the corporate strategy area there. And we did 45 acquisitions while I was there. And I was involved in some of the integration work, more so than the actual deals. Some big deals too, you know, well into 9 figures, a couple of them. But what I learned in that experience was, you know, how private equity really scales companies, how they think about them differently, the mindset. And long story short, I'll finish there. That took me on a road, if you like, to working in private equity for a number of years, almost a decade, up until almost pre-COVID when we met, when I made a change. So, so my background's private equity, scaling companies, turning them around and exiting.
So when you and I first met, like, I love telling this story. Like I was sat at the back of a coach in Tenerife, Spain. And I was at the Tony Robbins Life and Wealth Mastery event, right? And you walked up to me and you said, "Hey, I'm Nick Bradley and I'm in one of your programs." And
That's right, I was.
I closed a deal, just want to say hello. And then we became like really good buddies at like that event. We were jumping off trees and doing all that kind of crazy shit.
Oh, it's funny. That was so much fun, wasn't it?
It was so much fun. But I remember at that event, like some of the work that we did in the room. I think were you going through that transition at that point?
Yeah. This is why I think we've become such good friends as well. Because that was a pretty full on experience for me. I started a Tony Robbins journey, and that was I think the last event I was going to. I'd done Date with Destiny, whatever. But man, I was reprogramming like a lot of stuff over that time. Yeah,
me too. Like I remember. Like my Tony Robbins journey, I remember one night, this was, I think, 2018. I don't know why, but I went to bed that night and I just wasn't feeling great. And I'm goofing around on Netflix and I'd read a Tony Robbins book and on Netflix, it served up to me that documentary, I'm Not Your Guru. So I watched it. Have you watched that, I'm Not Your Guru?
Oh, God. Well, the reason I'm smiling here is that I was watching that with my wife after one of the exits I was involved in didn't go as well. And I said to her, I watched exactly that. And I said, you know what? I need to get to an event. And I actually looked up the next event, which happened to be in Chicago about a month later. And I booked tickets. So it was exactly that. So
same thing for me. I watched that event. I watched that documentary and I'm thinking, I have got to go to Date with Destiny. So it was January of 2018 and I'm watching this. And so I went straight on the website on my phone, like, how do I get a ticket? Like he tells you in the show, it's like $5,000. So I got to go, worth it. And then I thought, dang, he's just had the event in like wherever, Palm Beach.
It's December every year, I think.
December. And I'm January and I'm thinking, well, I don't want to wait 11 months. So I'm looking at all the events. It said, hey, there's an event in March of this year, Unleash the Power Within. It's in London. So I thought, right, I'm going to go. So I went, insane, 4 days, walked on fire, all that kind of crazy stuff. And then at the event, I dropped the $10,000, I think it was, for what's called Mastery University. So you've got to do Date with Destiny, Life and Wealth Mastery, and Business Mastery, right? So I bought those.
I did exactly the same thing. In fact, at the same time, I went to the UPW in Chicago in June 2018, and I ended up buying the 10 grand thing, which was awesome. And then ended up going to Date with Destiny in December 2018 in Palm Beach.
So I was there.
And we didn't know each other at this point.
No.
Right, but we were the same,
Well, there's 5,500 people. So I was at that event, right? I was at that event, and I don't know if you remember, my very, very good friend, Jesse Eeka. So you know T. Harv Eker?
Yeah, I know of him. I don't know Jesse's. Jesse's son.
T. Harv Eker's son, Jesse, who runs all of his dad's companies.
Okay, got it.
I got to know him. He was an affiliate of mine for my business acquisitions program, right? So he was affiliate selling what was then the Business Buying Accelerator, which is, I think, what you came into. Now it's Protege, right? But that program way back then, he was my affiliate, and I knew he was going with his wife. And I don't know if you remember at that event, he's the guy that won the Harley Davidson.
Oh, I do remember.
You know,
I
when the
remember it
wheels
as clear
spin.
as day, even though it was 5 years ago. But because you'd already started your acquisitions business back then. Ninja Acquisitions was initially
Yeah,
what it
so
was.
I started Ninja in 2016,
Okay.
and we were kind of I was doing all the stuff and like what. So I did Date with Destiny, and then I think one of the most powerful events I did that in the December 2018, and then in January 2019 I did Business Mastery back at West Palm Beach.
I've never done that one. That's the only one I have. I haven't done that or leadership, and I think you've done both of those.
Yeah, so Business Mastery is really cool, right? So what that and for guys like you and I that know numbers and strategy in business, it's the content itself is like a lot beneath like where you and I are at, but it's not designed for really people like you and I. But like, the big takeaway I got from that was that I need to be an owner investor of Ninja, not an owner operator. So the big switch in my brain that day was I've got to get out of the way of my business and build a team to kind of execute, right? And then what that meant, and I think this will be a great segue into the rest of the conversation, is because before that time, I had a business that had zero value. Now, I'm not saying I didn't have EBITDA. I was probably cranking $1 million of EBITDA at the time in what was Ninja, but it had no transfer of value because I was the business, right? Everything was in my brain. Without me, the business was not going to work, right? And I made that switch at that event to say, well, if I want to sell this business one day, and I didn't at the time, but if I want to get out of a deal and get some value, I've got to work on the business and make the business work without me being inside of it. So that's what Business Mastery taught me. And then fast forward to the Life Wealth Mastery event where I actually met you. I signed the deal at that event to sell my business to Agora.
I remember that. I remember exactly that point because it happened pretty much at the event.
Yeah. And what was really cool about that event is I wanted to join the Platinum Partnership, which was like, it's like $150,000 a year when you factor in flights and all the other events. It's like, it's 85K to join, then you've got to pay to do all the other stuff, right? So I'm thinking, well, I don't want to drop 150 grand until I sell this deal. And the deal closed while I was there. So I joined, and last day I'm wearing the hat and did all that stuff. Never actually got to do Platinum, by the way, because of
I was going to ask, I don't think you ever did it, did you? I remember you having the hats and going to the dinner and stuff like that, because I remember you walking out like at a lunchtime thing saying, I've just signed up.
Running out with my hat on. I'm a platinum. But no, I never got to go to an event, and I got my deposit back because, they canceled all the events through COVID. But
oh, yeah, of course.
But what was good about that event was it the mastery of it. So the Day with Destiny event just leveled me up just to perform at a different level. The Business Mastery event got me really dialed into, I need to be separate from my business so I can sell it, which I did. And then at the Life and Wealth Mastery event is when the deal closed. And then I had a pretty interesting time with Agora for about 9 months. But then, and this is something that, you and I talk about a lot, is sometimes culturally deals don't work, right? I always look at deals like you. I came from the world of big M&A, so HP, Bank of America, like monster deals, and like we always used to look at deals through 3 filters, and we used to say, well, what would have to be true for this acquisition to work? Well, number one, it's got to have a strategic fit, right? Can we cross-sell products and services and get cost synergies? Number two, is there like a systems fit? Like, you probably remember the old deal where TSB and Lloyd's merged. And the reason why that deal just completely never worked is the technology inside of those 2 banks could never talk to each other.
Well, it happens. That happens all the time. I mean,
yeah,
we'll get into
and the deal didn't work. And then the third deal breaker is cultural fit. And like what I think was evident with Agora, being $1 billion company, buying a small multi-7-figure dollar company, I just kind of fell through the cracks, right? So I ended up getting the business back from Agora on creative terms, and that they rebranded it to become Dealmaker Wealth Society away from Ninja Acquisitions, and obviously now Dealmaker, through partnering with Chris Moore, who you know very well, we've 7x'd that business since we took it
Well,
back.
I mean, let's just play with this for a second, because there's a couple of things I'm going to ask you. As a podcast host myself, I'm going to ask you, Carl, some questions.
Absolutely, let's go.
First, because I think it's useful as we get into this. Firstly, the transition from you being in the business to on the business to exiting within the space of effectively 24 months.
Yeah.
Is bloody incredible. Just to say that. When you made that decision to build the team, what was the first thing you did? How did you identify what you needed? How did you go and find the right people? How did that look?
Yeah. So what I did is I discovered the EOS model.
Okay, so Gino Wickman's effectively
so
Traction.
I read all those books, Traction, Get a Grip, Rocket Fuel, and I architected in my brain, and it was kind of like the old Michael Gerber stuff. I got to know Michael Gerber very well about 5-6 years ago, and I'd read E-Myth, and where he talks about the entrepreneur, the operator, the team. EOS talks about the visionary, the integrator, and then the three-legged stool of the business. So first thing I did was create that. So I just bought my company back from Agora. There's me plus a couple of VAs, everyone else is gone. They got rid of most of my team when they acquired it, which is what you typically do. So I thought, well, for me to rebuild this business, I don't want to work in this business anymore. I'd already retooled it to sell as an owner investor. For me to continue with this business as an owner investor, I need to build a team, right? So I determined, first of all, that my business was a three-legged stool. So I needed a marketing person, I needed an operations person, and I needed a finance person. And then I needed an integrator that would drive the bus on a day-to-day basis. And it was a freak of nature, really, that Chris Moore was he literally, just as I'd done the deal, he calls me. And he was going through, he was a partner in a big marketing agency, and he called me and he just wanted some advice. So was kind of coaching him through that deal. And then he closed that deal and he exited, and then he went through a period of illness, which he recovered from. And then he just called me out of the blue one day. And I'm like, hey, dude, what's going on? He said, well, and we had a mutual friend, because I met Chris in Todd Brown's Top One Mastermind. And there were a bunch of us that remained really kind of close friends. And he was talking to Sean, one of our buddies, and he said to Sean, I want to do something amazing now. The only person that I can think of that I would ever want to partner with or do something with is Carl, right? And Sean says, well, call him. So he called me. He's like, where are you with Ninja, Dealmaker? I want to get involved. And I said, let's go. So you
were looking for someone at that point, effectively.
I was looking for somebody that would get hold of my business, right? Understand my visionary map for what I wanted to achieve, and then basically just take that, execute, build the team, and just get on with it. And that's how it worked, right? So we turned into the Batman and Robin. And I remember I flew out to Nashville. We had a crazy weekend in Nashville where he introduced me to moonshine. That dude can drink, right?
What is moonshine? I mean, segue here. Is that a really full-on whiskey or some shit?
So it tastes like diesel. It's 80% alcohol liquor. It's probably, I think it's what got made in the Prohibition years back in the day.
Okay, so when they couldn't get anything legally or whatever else, they had to make stuff from petrol.
I think it's really good for two things. Number one, degreasing engines, and number two, killing brain cells. So I'm drinking this moonshine stuff, and it destroyed me for a few days. But anyway, I remember he then invited me down to, he lives in a beautiful big lake house down in Alabama, right near Huntsville. And I remember we're driving down, and he has this giant truck. You know how big the cars are in the States.
Oh, right? God, yeah. One of the guys I work with in Detroit has got this monster truck that goes as fast as a Porsche sort of thing. Yeah.
So Chris has got one of those, right? So we're driving in his truck down to Alabama, and I just said to him, I'm like, Chris, let's just be 50-50 partners. And he's like, are you crazy? I'm like, no. I'm like, I see talent in you. We have an incredible business chemistry. You're the classic integrator. I'm the classic visionary. I've painted the picture of what I want to do, which is basically create a $1 billion online education roll-up. We'd spent the whole weekend kind of mapping that out. And I said, I absolutely know you are the guy that can execute on that, and we can be partners, and I'll just split the business down the middle with you. And he was like, wow, that's like, I wasn't expecting that. He's thinking like I might give him 5% or 10% or vest him in over.
What was your thinking there? I mean, like, the whole thing Hormozy says about make an offer that someone can't say no to.
Yeah.
Right?
Yeah.
Like, that's like incredible. So was that part of the thinking, or was it just that you thought, it had to be that way for you guys to operate because of then you weren't the boss, so to speak?
Yeah. So I thought, I want to give this guy complete day-to-day control of how this business is going to work, right? He completely understands what I want. Like, and for me, we had to be partners equally to give him that responsibility, that incentive to absolutely smash this out of the ballpark, which is what he's done, right? So if I'd have turned around and just said, well, yeah, I'll give you 10% and we'll vest you up a bit more from that, I think he still would have like blown this up and done really, really well. But like, one of the things that Tony taught me when I went through Date with Destiny, right? I went into that event being very like selfish, being very money motivated, being very like material in nature. And I realized in that event that those were the things that were really holding me back. And I came out of that event reprogrammed, thinking, well, I want to be a really good coach. I want to focus purely on transformation. I want to impact people's lives. And I want to spread the knowledge and the insights that I have. Money doesn't matter to me anymore. The irony is, since making that mindset shift, I've probably made 10x my net worth just from that shift. Well,
it's what
focused on money. It's crazy.
It's what I mean, I often say the Zig Ziglar quote about if you help enough people get what they want in life, you'll have everything you want and need in life, is the kind of flip. My belief pattern changed at UPW because of that one quote. And it's true, right? Because you don't have to worry about money if you're providing that much value into the world.
Yeah, and that's, since I made that shift, what I've noticed is not only my own personal wealth scenario, but like a lot of people that have come through my programs, like there's guys have made 9 figures. It's a very funny story. One of my students, Mike, lived up in Boston, right? He was one of my early kind of students in Protege. He calls me up one day when there's like 1,000 people in my mentorship now, but back in the day when there was like 10, they could call me up, right? So he calls me up. He's like, hey, and he'd bought a wealth management company. He'd bought an MMA facility, a kickboxing gym. He'd done all these deals, right? So he was a solid deal maker. He said, I've got this really awesome deal, and I'm really going to need your help. What is it? He said, it's a medical cannabis company. And I didn't know anything about the industry at the time. And I thought, well, major problem, right? Because it's might be legal in the state, but it's federally illegal, right? So you can't go to any SEC like organization. You can't go to a bank or a traditional fund. They're not going to lend money into cannabis. You got to go to Canada, or you got to raise private money, right? And I was doing a whole bunch of other things at the time. And he said to me, do you want a partner? And I said, well, no, I'll help you. I'll coach you, but I don't. So he said, well, how much would it cost me to get you on a plane tomorrow to fly to Boston? And I was in England, to help me with this deal. So I just threw a number out there, and he's like, right, cool. Booked the flight, went and did that deal. So I wasn't a partner in that deal at all. I could have been, but I wasn't.
So you helped what, negotiate it effectively?
Yeah,
and
so I just did it
review it.
I did it for a fee because he was my friend, right? He just paid for my time. He paid me a lot of money, but it's neither here nor there. But he scaled that business up, and what we decided to do was to leverage his wealth management business to get private money lenders in to fund the acquisition, right?
Got it. Wow.
Okay. And the acquisition, he bought 2 pieces of paper. That's all he acquired, right? Like, there was no business at the time. It was a couple of farmers. They wanted to build a grow site, and they wanted to open dispensaries to sell the medical cannabis products, right? All they had was, they bought 2 pieces of paper. So it was a creative deal. And all the capital raising was to basically build the company, right? The 2 pieces of paper, which is all you need in this market, was a permit and a license to grow and a license to dispense.
Wow.
So that's what he acquired on a creative.
How hard were they to get at that point?
Oh, like
difficult, obviously.
very,
okay.
very, very difficult. Like very, very difficult. So that was the barrier to entry. That was the moat, if you will. What Warren Buffett calls the moat around your business. That was the moat. So he did that deal, scaled that up, leveraged all of his wealth management clients to fund the build of the site. And then they exited that business 2 years ago for $114 million to one of the massive aggregators in the medical cannabis space, right?
Wow. And do you ever look back at that and think, God, a 5% in that would have been nice?
Yeah,
or more.
I know, right? Like crazy. But like, because I shifted my brain into wanting to help people. And like now he's an angel investor. He has his own family office and he's funding a lot of my proteges deals. Where my proteges are buying deals where there's a closing payment, right, required. Not all deals need money up front, as you know, but a lot of them do. He's an investor that's coming in and partnering. And as an investor partner, he's not just providing the capital, he's also providing a lot of entrepreneurial skills and a lot of mentorship. So for my business buying students, it's like they're getting double value. They're getting the cash so they can do the deal, plus they're getting a partner that's invested and is incentivized to kind of really help them.
There's a lot of that happening sort of in what I see in my world now, because, if I look back at how private equity has changed over the last, say, 5 years, there's about double the number of firms that are there now versus pre-COVID. Right? Yeah. There's a lot of cash too, but actually what's interesting, the definition of a private equity firm has changed. Yeah. So kind of what you just described there, right, is a family office type of private equity type of structure, which has made the private equity firms, the traditional firms, have to get better, right? Because if they don't get better, they're going to get locked out by these people who know how to do deals, they've got the cash to do it, and they've been successful in their own right with their businesses, so they offer more value than just the finances.
Well, what's cool about private equity, I suppose, is I think if you've actually got capital of your own, you're better off becoming a family office and investing in the deals, and then you're getting all the returns. I think the problem with private equity, whilst it's got so competitive now, is technically you're not investing your own money, are you? You're going out there, you're raising capital from limited partners, whether they're family offices, banks, high net worth, pension funds, all those guys. And then when you factor in, they get management fees on the money that's deployed. But if you factor in like they get a 20% carry traditionally, don't they? But if you factor in what's the IRR hurdle rate, unless you're blowing businesses up to the moon and selling them for big multiples, you're not really going to make a lot of money.
Well, that's the big change, because we used to measure it by a factor called MOIC, right? So you'll know that, but for everyone listening, multiple on invested capital.
Yeah. And
it's a different equation to a return on invested capital, because you're looking at the multiple of the value over time, over that, and time doesn't really come into it. So the internal rate of return piece becomes secondary. But on average, if I'm a private equity guy, I want to get at least a 3 times multiple on invested capital, but ideally higher than that, 5 or 6 times.
Is that the way to think of that? Is that deal by deal basis, or is that on the fund?
It's on both, to be honest, but on a deal by deal basis, you get a little bit more. The way it works, right? And I've got this coming out in my book very soon. I talk about what it's like to go into a private members club in London that's a private equity club, and how they talk about it. You'll like the chapter, because I put it out there and say, for one night, you're going to go behind a secret door. A door in London that you wouldn't even know there's a club there, right? But it's a secret wine club.
I've been behind a few of those in my time. I'm sure you have.
I'm sure, yeah, exactly. But just for everyone listening who may one day enter one of those clubs when they sell their business, this is what happens. But you sit there, right? And if you've had a business that's sold for, say, 2 times MOIC. So to put some context to that, let's say you've put 50 million into a business, you might have acquired something, bolted other things on, and then you sell that for 100 million. That would be a 2 times, right? But you want to try and get to a 5 times. Yeah. So if you put 100 million into something, you want to get a 500 million return, right? That's the sort of numbers. If you get a 2 times in that club, right, versus the guy next to you at the table who's done a 5 times, you're the schmuck, right? You probably wouldn't even go out because everyone's going to laugh at you. So the point I'm making here is there's a lot of competition and arrogance and all this sort of stuff. And the reason they could do it like this is because the cost of capital was so low, right? Interest rates, debt, exactly. And this is where I've been writing about this quite a lot lately on social media, because people need to know it.
Yeah.
When cost of capital is low, you can go out there and put heaps of debt, right, at pretty high interest rates. In other words, the interest rates that the private equity firm puts and labors on the business.
Yeah.
And then you make a return on everything.
That's right.
Like everything. But when the cost of capital is high, as it is now, right, all the private equity firms don't know what to do.
Yeah, because like when interest rates were at 3%, and let's say that 50 million, the fund puts in 5 million of its own equity capital,
Yep.
puts 45 million in of debt. They're buying that debt for 3%. They're charging the business 12%. So
Exactly
they're getting income, they're getting a yield, and then
Oh,
they're getting the capital return when they exit, right? So they might make 8 times their equity and 2 or 3 times the overall investment. But
they're making a lot of money from multiple sources. The one deal, the final deal I was involved in, the principal on that deal, now he held the business for 8 years. He took out $340 million, Carl, personally, from that deal. Wow. And that was a deal that went for almost $3 billion, just to be clear.
That's crazy. But now, because interest rates, I've just done a deal. I borrowed money at the high 8s to do that. So now, you know, even if you're charging the business 12% or even 15%, that's not a lot of kind of margin to kind of play with. But so now, like, your focus now is, and like one of the like mandated listening for my proteges. Like after you did you very kindly spoke at one of my events, and then you came and you spoke to my advanced group. And after that, we made it mandated reading or listening for everybody to listen to it's my favorite podcast episode that you've done, the 15 reasons why PE won't buy your business, right? And obviously we're not playing in you're playing in the middle market, right? So you're in the 10 to $100 million deals. Where
pretty much. I mean, the mid market for me, to be clear, starts at about 30 to 40 million, and that's lower mid market, but goes up to about 200 to 250. Yeah. So it's quite a big part. So some of but it's what I'd call, it's not the $1 billion exits. Yeah. It's that sort of lower 9 figure at the max.
Yeah. So if you're in the Premier League, let's have a soccer analogy. So we're in the championship, right? So where my guys are doing like $1 to $10 million acquisitions, probably 2 to 5 is kind of that sweet spot. But a lot of the rules are very similar, because like I know now you'll take a business and your goal really is to rapidly accelerate the kind of shareholder value, which is a phenomenal thing that you do. But a lot of those principles, they still apply, you know, for these smaller deals. And they probably apply a lot more, because like one of the things that we talk about a lot in Protege, in my mentorship, is that like if you go to business brokers, right? And you go to anybody else in the market that's really valuing deals, like CPAs, business brokers, even attorneys, they only look at valuation through one lens.
Yeah, precisely.
And it's financial valuation. So it's looking at the business, it's recasting or adjusting the EBITDA, taking whatever average, looking at what the multiple would really sell for in the marketplace.
That's right.
Adjusting for working capital, debt, whatever, surplus cash, and then that's your valuation, right? They're missing 3 big other lenses. Number 1 is deal structure, right? So one of the things that we looked at is I looked at 50 of the deals that I've done in the last 10 years, and I looked at a couple of hundred of the deals that were done by people in my protege program, right? And I built a model and I analyzed all those deals. And what I found was that, quite rightly, the more creative the buyer gets on the deal, the more of the deal that goes into future, we call it seller financing in America, but you know, deferred consideration, you know, promissory note, earnouts, whatever you want to call it. The more of the deal that's in the future, the more you're going to have to pay. It's like when you go and let's say you go and buy a Tesla, right? Like you can rock up to Tesla, drop 50K and buy it for cash. Or if you want to finance it over 5 years, you might pay 70,000, right? It's the time value of money. And so that happens in business acquisitions, as you know. So the more of the deal you put into the future. So deal structure I was seeing in the market is never getting factored into valuation. The second thing that was never being considered was seller psychology, right? So if you look at 2 businesses side by side, they're identical financially, strategically, but you've got a distressed seller that maybe is sick, tired, bored, frustrated, wants to come out. Yet you've got an entrepreneur. Like, and you know, I own 26 companies today. Some of them I hate. I would sell for $1 down all day long. But I've got others that like, no, I'd want a crazy multiple to even consider selling. That's got nothing to do with the EBITDA. It's got to do with how I feel and what my psychology is about that business. No one thinks about that. So we got into all that. And then, then the third extra lens, which is where I think PE really shine, and we're trying to put this into our own deals, is what we call the transfer of value, right? So again, imagine you've got two businesses. They're identical financially, right? The EBITDA is the same. So the multiple would be the same, right, for the type of business. But one business is high growth, high margin. It's got low customer concentration. It's got a management team. It's got fully dialed in KPIs. The owner is nowhere to be seen inside of the business. That surely needs to have a much higher multiple than a business.
And it does. And it
low
does.
Growth,
and
low margin. Like,
this is the key thing. So I call it transfer value as well. So there's actually a few more bits, but just to build on what you said, right? So, and I'll talk about how the private equity thing operates too, because I think it's important for people who have a business who want to exit one day to understand that world, right? So financial value, right? Financial value is an academic equation from over 50 years ago, right? So when you things like net present value and all this sort of stuff, right? So years ago, that was the only way that anyone looked at a business, right? They didn't look at the culture. They didn't look at the kind of, recurring revenue, all the things we just spoke about, right? But what happened in around the late 90s, early 2000s, right, certainly exposed quite a lot by digital and the fact that we could get access to metrics that we didn't have. So if you think about it, back in the 50s, 60s, 70s, there wasn't the access to the metrics that we have these days. We can get very dialed in, okay? So you've got this kind of weird thing that happen. And the market has caught up in certain ways, but in other ways it hasn't. So you've got the financial value, right? Usually a multiple of EBITDA, sometimes revenue. Then you've got the transferability of the asset. And this is where we end up with this concept called the range of the multiple. Right. So same industry, same profit. One business sells for 6 times EBITDA. The other business sells for 20 times EBITDA, which does happen, right? Particularly if you sell to a strategic who wants you and all these things. What's happened there? What is the difference? Because on paper, they look the same, right? Everything in that podcast you mentioned kind of covers some of it. But there is one last point, right? And I call it prize versus prey. And I talk about this quite a bit. If you have the mindset, the psychology, you understand how the game is played by sophisticated buyers, you can actually control the emotional situation that happens through a deal. So I've been involved in transactions where I'm gonna hit the trigger on the financial valuation. I'm going to get the transferability because I've built the business the right way, but I'm going to get an extra bump on the negotiation because I've outplayed my worthy opponent. And if you understand those three things, that's how you realize a very high value exit.
Because when you look at multiples, right? So we talk about the range of multiples, and I think a business owner can't control what the range of multiples are. That I think they're really determined by the capital markets, aren't they? Right?
They are 100%. And one of the things, just to build on that, I sometimes do in businesses is, let's say you're an education business and the range is 6 to 14, right? But you could be positioned as a data services business, and the range there is 10 to 18. So you can actually change the positioning of the market you're in as well if you give yourself enough runway to work on it.
It's crazy. And then I think what people don't understand is that whilst the business owner can't control the range of multiples, they can control where they land within 100%. The multiples based on how sophisticated they either build their business or, to your point, how they position it to that target buyer. And then really it's like do you remember when the PS5 came out?
I had to go and buy the thing off the grey market.
So did I. Because $1,500, right? I paid 3 times the going rate because you just couldn't get them, right? It's like if you want to go and watch the Lakers, right? As you know, I'm a huge basketball.
Well, so am I, mate. I'm seeing the Celtics play in 2 weeks, so I'm a Celtics fan, mate. So we're going to probably have a fight about that.
We're going to have a fight about it, right? You're going to go watch Celtics, but even to go watch the Celtics, right? Like you're probably paying double or triple on StubHub like what those tickets really kind of cost. Yet it's just supply and demand in the market. And I think that's what drives crazy exits. If you've got a really unique business that's got massive strategic and financial value to multiple buyers, people are going to bid that up. I saw that in my corporate days. I once paid 44 times EBITDA for a software company that was going to completely transform HP's game in the data center, which was being dominated back, this was 2005, dominated by IBM. HP was getting slapped all over the market. And we knew if we could buy this company, it would change the game, right? So who were we bidding against? IBM. Because IBM thought, well, crikey, if these guys buy this company, like we're going to be in for a fight. Is it not worth us buying this company and then just basically putting it in a box and taking HP out of the game? So they threw in the towel at 44 times EBITDA, and we persevered, right? So,
some of the numbers, like if you look at the big exits over the last 5 to 10 years, like the WhatsApp acquisition by Facebook, or when Motorola was sold to, who was it in the end? Microsoft? No, can't remember. But anyway, but they were, the multiples go up to like high double digits, like 86 times EBITDA and stuff like that.
Yeah, and then sometimes the multiples, they don't exist, right? Look at Salesforce's acquisition of Slack, right? Slack's never made any money.
Yeah.
Slack has no EBITDA, right? So they bought it on a multiple of eyeballs, I think, because
it was also done on the people, this whole acqui-hire thing, where sometimes, because it's funny, the soft drink brands like Coca-Cola and whatever else, they've de-invested in their innovation departments, and all they do is go and acquire the startup that looks like it's getting traction, like Vitamin Water. Right. So, you get all those things, but the message I think it's important for any person who's acquired a business is a business owner. What I often try and say, and this is kind of my purpose really, is to say, listen, you want to have a business that is exit ready, right? You want to have a business that you can sell at any point in time on your terms and timeline, right? Even if, and this is the important bit, even if you don't plan to sell it immediately, right? Because if someone calls you up and says, hey, I want to buy your business next week, literally this happens, right? Strategic calls up and says, hey, listen, we've been looking for a business like yours. We need to complete within the next 90 days. We want to come in next week with our team and start the process. If you can say, hey, you know what, I'm ready. Come in today, right? Yeah. Imagine the power you have, the choice.
I know. That's just happened to me, actually. So I'm doing 2 big roll-ups right now. My goal for these 2 roll-ups is to them be both publicly traded $1 billion valuations, right? One's in the health and beauty e-com space. One is in the online education space, which is targeting business owners, investors, and entrepreneurs, right? And it started with Ninja, which was sold to Agora, bought back, which is now Dealmaker. And we've made 4 acquisitions. We bought a real estate coaching company. We've bought a marketing growth coaching company. And then we've bought transactional businesses to help our students like accelerate faster, right? So we've bought a CPA firm because everybody needs like financial help.
God, I get people always wanting fractional CFOs and things like that when they're scaling. 100%.
We've got a marketing agency so that people want to grow the businesses that they buy. They can plug our marketing agency in, and they'll take care of like ads and funnels and opt-ins and all that kind of stuff, right? So we've built a machine, and we're probably doing about $5 million of EBITDA run rate, right? So it's a nice business. So I got a call 2 weeks ago from a PE firm that's also doing a roll-up. So they want to roll up the $5 million EBITDA businesses. I'm rolling up the $500,000 to $2 million EBITDA.
Well, there's a threat. Just to jump in there, there's 2 thresholds, right? You've got the 5 and the 10 in the mid-market. So I often say, if you get to 5 million EBITDA, you've opened up 1 layer of private equity. You know how we say sometimes people who've got businesses that are too small as a standalone, they can never exit, right? That statistic of 2 in 10. The reason is they're not opening up the market. Simple as that. They're not opening up where the capital is. But 5 and 10 are the thresholds in terms of EBITDA. So if you go to 10, you're likely to get well into the higher end of the mid-market for a 9-figure exit.
That's right. So they called me up and said, hey, we've been looking at what you're doing. We know like Dealmaker's a really cool brand. We love what you're doing. You're putting all these Dealmakers into your program, and you're buying all these other businesses. We've been watching you. And it's like, yeah, we'd love to acquire you in your current state and put you into our like giant roll-up. It's like, you know, I'm a big, you ever watch Star Wars movies? I'm a massive Star Wars.
Oh, mate, we go to Orlando to Hollywood Studios about 2 or 3 times a year just to hang out and buy blue milk in the Star Wars bit.
Just to go to Los Angeles. And have you done, I know we're diversifying, have you done the ride where I think it's called the Rebel Run, where you get on the ship with, I think it's
is that where you land and you end up in a spaceship and you see all the
and
do you know what we did? We ended up doing the
right. They're really mean to you, like
Horse, great, like,
oh my
so
God.
good.
Yeah,
we even did the Galactic Star Cruiser car before it closed down. We actually stayed on the Star Wars hotel. That's how much of a geek we are on Star Wars. Anyway, we get distracted.
So if you remember the very, very first Star Wars movie, Episode 4, where right at the start, Princess Leia's in the Rebel ship, and Darth Vader's big like ship comes and swallows it up. Like those are the guys now that are kind of circling around me. The Darth Vaders, they're coming in and they're getting me.
I love it.
The tractor beams, right? And they're trying to suck me in. And like, you know, they said, hey, you know, like, you know, what's your EBITDA? We're thinking you're probably in the 4 to 6 range. So, well, yeah, I'm like right bang in the middle. Probably run rate doing about 5 million recasted EBITDA, right? And they said, well, you know, do you want to sell? And I'm like, no, I don't want to sell. Like my goal is to probably get to 20 million of EBITDA over the next 2 or 3 years through a buy and build strategy. You know, I've got my next 6 or 7 deals mapped out. We've raised tons of capital to do those deals. A lot of my own students have even invested in this as well. So Dealmaker now, you know, Chris and I have like diluted over 50% of our own shares. We've got probably 100 other micro investors now that are people in our programs that really believe in what we're doing, right? So we're doing all these deals, and you know, my goal is get to 20 mil. And then I think if I do it properly, I've got a great story for the market where, you know, we can buy an OTC shell, uplist to the NASDAQ, and then I can act as capital probably at a 10x multiple, leverage that up with debt. So I'm buying, my buying power's at a 20 times EBITDA multiple, and then I can buy businesses in the 4 to 8 range, and then just keep going because I've got the team that can A, buy the businesses, and then B, integrate them into the mothership and do what we're doing. So like, I don't want to exit now, right? I'm not even started in this journey, but it's really interesting how PE, they're watching you, right? PE and strategic buyers, they're watching everything that we're doing. And like they see, they don't want to do the work of hoovering up these smaller companies. Which
well, private equity only cares about scale, right? Ultimately, that's why the range starts at that 5 million. I mean, I was working for a firm in London where we had a number of transactions that were put in front of us where the EBITDA was sub 5 million. And I remember the firm principal would say, I'm not touching that because it takes just as much effort and work and there's more risk. So why would I care? Whereas you've got all these acquisition entrepreneurs and all the stuff that's, you know, coming into the market doing exactly what you're saying, probably the more sophisticated ones. Private equity is sitting there waiting to stomp because, you know, like we kicked off this conversation, if they don't do deals, they close down, right? Like, because the money, it's funny this, when you put money into a private equity firm, not when everyone knows this, it's not like you put all the money in, right? You make a promissory note, right? You effectively say, I'm going to give you this if the deal flow comes in.
Yeah.
And then there's a call every time a deal's put in front and you put a bit of your cash in. But if deals aren't coming forward, then I can remove my note, right? Like I've got my, particularly if I'm a high net worth individual, I'm going to put certain restrictions. So they have to do deals. That's why right now, people ask me all the time, is private equity, is the bubble going to burst? So I did an article yesterday on this. And I said, I don't think it's going to burst. I think they're becoming more creative about how they deploy their money. Right, they're doing more growth capital and stuff like that. But there's $9 trillion in latest counts, in the latest PitchBook analysis that came out yesterday. $9 trillion or 960 billion or something ridiculous like that in private equity. So if private equity didn't exist, you've got to ask the question: where would the money go?
Yeah, it's got to go right.
Yeah, it's not just all going to go into real estate and Bitcoin. Yeah. So I think what's interesting is, and I say this to people, if you've got a business, again, you can do what you're doing 100%. There's different ways of exiting. But private equity has something like 50% of all transactions now, right? Because they're also invested in strategics and whatever. The prediction is that's going to go up to about 70%. 70% of all major transactions will be private equity transactions in the next 3 to 5 years.
And that's crazy, right? Because all that's going to do, that's going to drive up the multiples. Because if you've got private equity wanting to do more of these deals in this kind of roll-up aggregation model, and then you've got the strategics that are trying to do the same thing, if more buyers are coming to the market, and as you know, only 1% of businesses that exist ever get beyond 10 million in revenue, you've got all the buying action is where there's the smallest number of deals. So simple macroeconomics, that's just going to drive multiples.
It puts the prices up. Yeah, and that's why strategics right now. So I'm involved in a number of businesses, and we're focused pretty much exclusively on strategic exits for the next probably 18 months. Yeah. Prediction being early 25, PE will start to become a little bit more assertive. Yeah. But the multiples are crazy. Like, they are literally crazy. And if you're in the right sectors where there's a lot of just consolidation, right? Again, it comes back to what we said. If you've got a crap business that isn't transferable, doesn't have any of those things, you ain't going to sell it anyway, right? Like, it's just a problem. It's going to be asset stripped. Yeah. Whereas if you've got something that has got those, what I call foundations and fundamentals in place, then you have a great chance of exiting for a life-changing amount of money.
Yeah. Yeah. And like what I'm struggling to get my head around is, like, if you look at the market right now, so if we say all the price actions with these smaller cluster of like really good deals, interest rates are really high right now, the multiples are going higher. Isn't it then a lot harder for PEs to make money because they won't leverage as much debt as they used to because the cost of that capital is so high, right? So what
they're doing is they're taking more from the investors. So this is where it starts to become a little bit interesting. So I said beforehand that the investors don't put all their cash in, but I also said there's $9 trillion sitting kind of promised into these private equity firms. Yeah. So those ultra high net worth individuals, those pension funds, they still have to deploy their capital. So they're deploying more into deals than they traditionally did. Okay. Now, what does that mean? That means that the private equity firms have to be super discerning about the deals they do. They can't kind of have a crash. Yeah. Right. They have to back the winners. Yeah. The other thing they have to do is they have to become more operationally involved in their acquisitions. Right. So instead of like, because I remember when I used to go and do turnarounds when a private equity firm used to buy a company and they got it wrong. They can't afford that anymore. Yeah. So they're starting to bring more people in who can help with the scaling, if you like, or the optimizing and improving. So I think there's right now, to summarize that, I do think private equity is in a bit of a weird spot because they're trying to reinvent themselves a little bit within this world of kind of cost of capital being high. But they'll come back. I mean, some of the smartest people I've ever worked with in my life, Carl, are in those firms. Nice. Right. And they're not gonna like sit back, and they're ambitious, they're cocky, right? They want to win. They ain't gonna lose.
Cool. Well, Nick, I'm really conscious of your time. I'm gonna let you go. But for all of my peeps that want to learn a lot more about you, where can people find you online and connect with you?
Yeah, absolutely. I hang out probably the most on LinkedIn, right? So I pretty much post every day different stuff around private equity and exits and stuff. So there, definitely reach out to me there. My website is highvalueexit.com. Right. My podcast is Scale Up with Nick Bradley. So we talk about broad stuff there. Yeah, there's been some great guests like Mr. Carl Allen himself.
Thank you.
And the last thing is I've got my book coming out very soon, which is called Exit for Millions. That's coming out in May. And it's a proper deep dive into how private equity does this. Because what I want to do is get that private equity thinking being accessible to business owners before they would ever entertain going into that world. So it's kind of like, that whole going into a gunfight with a knife. I'm trying to give the business owners the bigger gun.
Yeah, I love that. My book's out in March. It's called The Creative Dealmaker. It's lovely. It's a fable. It's not like a technical book like my existing book. It's a fable. It's about
like that book, like when
Built to Sell, Sell, with Warlow, or Get a Grip, the Gino Wickman book. The reason I wrote a fable, so it's about a buyer and a seller that the buyer, frustrated W-2, wants to buy a company, seller looking to retire, wants a legacy and safe pair of hands, and they meet. And the story teaches all the core principles of what I do, which is how to find negotiate, raise capital, all that stuff. But then what I felt by writing a fable is you can capture the drama and the emotion and the psychology.
Yeah, you're right.
Of
You're
deals.
100% right.
It's probably not as prevalent where you play, because I'm from that world originally as well, and those deals, like 9-figure deals, are a bit more mechanical and so on. But when you're doing a $4 million acquisition and you're buying it from a retiring baby boomer, there's drama, emotion, and psychology that go into that, and you can't capture that in a technical book, right? So, like, by telling the story of how it works, like people getting like cold feet and
yeah, love it. Well, it does happen. It does happen with the big deals as well, but it's just hidden a little bit more. But there are, I mean, I don't know, we haven't got time for it now, but I did get thrown against a wall once in a private equity boardroom when a deal wasn't going well, and this other guy tried to pick up a chair and throw it out the window, but it actually bounced off the window and hit him in the face. So there is drama. It's just you don't hear it maybe as much as you do with some of the smaller transactions.
Well,
so
I'll send you a copy of my book when it's out.
We'll get you back on. Let's get you back. You know what? The other thing is, because you were on the show, as you said, a number of years ago, and your model has evolved. So let's get you back on my show, and we can chat through that as well, because I think that will help a lot of my listeners.
Will do, mate. All right. Well, Nick Bradley, thank you very, very much for coming on the show today. And we'll definitely catch up a little bit later. So that was a great show. Thanks, everybody. We'll see you on the next episode. Until then, bye for now.